A very good evening to the Lucknow DTRTI webinars. Today our topic of discussion is basic accounting procedures, and within that we are going to study journal entries today. From today rather, and we'll be going slow and steady, trying to enter into the very basics of how bookkeeping is done. And after studying this unit, you'll be able to understand what is the meaning of double entry system, what is the significance, how important double entry system is to bookkeeping. You'll be also able to familiarize with the term account and what does the term account stand for. And we'll also try to understand the classification of accounts into personal, real, and nominal accounts. We'll also understand when we classify the accounts into personal, real, and nominal, why do we do that? What is the utility of classifying the accounts or subclassifying the accounts? We will also understand how debits and credits are determined from transactions and events, because as you know, what we record in the books of accounts are the transactions or the events. But while recording, we have to assign debit or credit to a transaction or to an element of a transaction or an event. So how do we determine the debits and credits? Also, the points that we must take care of while recording a transaction in the journal. We have to understand those points that we have to take care of while doing that or while doing a journal entry. So, as an overview of this unit that we are going to study, the source documents are the documents in the books which contain the financial records and which are the evidence of the transactions. Now, from the source documents with us, which are the evidence of the transactions, which contain a financial record, we go ahead and we prepare the books of the original entry from the source documents, or rather we use the source documents to prepare books of original entry and ledger accounts. And once we have prepared the books of original entry and ledger accounts from the source documents, we then go about preparing the trial balance. So that is the broad procedure that we adopt. Now, from the source documents that we have with us, which contain the financial record and which act as the evidence of transactions, we make entry into the original entry books. Now, which are the original entry books? The purchase book, the cash book, the sales book, the purchase return book. You can even say a sales return book. And of course, when we say ledger accounts, those are the accounts where information relating to a particular asset or a particular liability or a particular capital amount or income and expenses are recorded. So ledger accounts are those accounts where the information about an asset, liability, capital, income, or expenditure are recorded. And of course, the trial balance is the totals of the various ledger accounts that we have already prepared. And so we prepare the trial balance statement from the ledger accounts. Trial balance is a statement that contains the totals of all the ledger accounts which are listed there in the trial balance. And the trial balance acts as a preliminary or the initial check on the accounts, whether the accounts have been written correctly or not, whether there are any errors in the accounts. So that is a preliminary or the initial check before we go on to produce the final accounts. So the final accounts will be prepared from the trial balance. So once again, to repeat it, we use the source documents to prepare the books of original entry and of course the ledger accounts. And from the books of original entry and ledger accounts, we prepare the trial balance. And from the trial balance, we prepare the final accounts. That is a broad process that we adopt. Now, as an overview, all accounts are classified into two types: personal or impersonal. Now, those which are impersonal accounts are classified into two types: real and nominal. And those accounts which are personal accounts, they are classified into natural personal accounts, artificial or legal personal accounts, or the representative personal accounts. So the accounts are basically classified into two categories. One is the personal account, another is the impersonal account. And impersonal account are two types: real and nominal. Having said that, now let us go deeper and start with what a double entry system is and when it did start. So double entry system of accounting is more than 500 years old. Now, Luca Pacioli, who was an Italian friar means somebody who's working in church, and a mathematician also. So in those times, most of the persons who used to study were somehow or the other related with the church also. So an Italian friar and a mathematician, he published a book called Summa di Arithmetica or Geometria Proportioni et Proportionalita, which means in Italian language everything about arithmetic, geometry and proportions. So Luca Pacioli, he published this book called Everything About Arithmetic, Geometry and Proportions. And this is the first book that described the double entry accounting system. So double entry system of bookkeeping has emerged in the process of evolution of various accounting techniques. As accounting techniques have evolved, double entry system has emerged in that process of evolution. In fact, it is the only scientific system of accounting. The other systems are not so scientific. Now, according to the double entry system, every transaction has two aspects. One is the debit aspect, another is the credit aspect. And we have to record both the aspects, the debit as well as the credit of every transaction in the books of accounts. So therefore, when we record any transaction in the books of accounts under the double entry system of bookkeeping, we make two entries for every transaction. Therefore, in every transaction, by every transaction, two accounts get affected. For example, when we purchase furniture, we pay for the furniture with cash, and therefore our cash balance reduces, and if we don't pay by cash, then we incur a liability towards the supplier of the furniture. And on the other hand, a new asset is acquired, which is called the furniture. So here, whenever we purchase furniture, two accounts will be affected. One is the furniture account or the asset account called furniture, and the other one will be either the cash or the supplier account. If we purchase it with cash, then the cash account will be affected. If we purchase it on credit, then supplier account would be affected. So therefore, the double entry system records both aspects, debit as well as the credit. It can be defined as a system which recognizes and records debit and credit aspects of the transaction, or both aspects of the transactions. Now this system has proved that it is a systematic system and has been found to be of great use for recording the financial affairs for all institutions which require the use of money. As you have seen, it is the money value that is recorded in the books of accounts. Now, what are the advantages of double entry system? Number one, by this system, we can check the accuracy of the accounting work as we are making entries through the device of trial balance. Because as we prepare the trial balance, if we have made any inaccuracies or any incorrect entries, then the trial balance would not balance, or some error would arise in the trial balance. So through the device of trial balance, we are able to check the accuracy of our accounting work in the double entry system. Now another advantage is the profit and loss for a period can be ascertained along with the details of the profits and loss also. So this system helps us to ascertain the profit and loss. Thirdly, the financial position of the firm or that institution concerned can also be ascertained. So second was profit and loss can be ascertained. Thirdly, financial position can also be ascertained at the end of each period of time by preparing the balance sheet. And then fourthly, the system permits the accounts to be kept in as much detail as necessary, and therefore significant information gets recorded for the purpose of control, etc. Because as you would be seeing that while making the journal entries, we give a description of the journal entry there also. The fifth advantage is that the result of 1 year can be compared with the result of the earlier year or the result of the next year, and therefore we are able to understand what are the reasons for the change in profit or the loss by making the comparison. Now we have seen how the accounting equation becomes true. Accounting equation meaning thereby the capital plus liability is equal to assets. A person starts his business with, let us say, 10 lakh rupees capital and cash, capital and cash together, both of them together 10 lakh rupees. The transactions are entered into by the firm. Whatever transaction the firm enters into will alter the cash balance. Either the cash balance will increase or the cash balance would reduce. Now, if the firm makes payments for goods purchased or it makes payment for salary, rent, etc., the cash balance will go on reducing. And when it sells any goods for cash and collection comes from the customers, then the cash balance would increase. Now, with every transaction, we can change the cash balance, but that will be a very burdensome exercise. Instead, it would be better if all the transactions that lead to increase are recorded in one column, and those transactions which lead to reducing the cash balance are recorded in another column. And so with every transaction, we need not record the balance change in the balance, cash balance. We can just take the sum of the transactions in one column which have led to increase of cash balance, and we can take the sum of the transaction in another column which have led to decrease of the cash balance, and then we find out the net result. That would be an easier thing to do. So we add all the increases in the cash balance to the opening balance of the cash, and then if we reduce the total of all the decreases in the cash balance, then we'll be able to know what is the closing cash balance, and in that manner significant information will be available to us relating to the cash. Now this is the way accounts are generally written. So when we are writing an account, we are not calculating the balance at every transaction stage. We are just writing the effect of reducing the account value on one side and recording the effect of increasing the account value on the other side, and after taking into consideration the opening balance, we find out the closing balance. That's all. So that is how accounts are generally written. So as an example of this, the two columns which we are referring to for cash, these two columns are put in the form of an account, and it's called the T form. T form which has a horizontal line and a vertical line in between. So every account has a T form, and or it looks like a T. As we can see, we can take some imaginary figures here. For example, we have a cash account, let us say. The opening cash balance is 10 lakh rupees. And with every transaction where the cash balance has increased, we have listed it in one column. And on the other hand, where transactions have led to a decrease in the cash balance, we have listed them in the other column on the right hand side, 7, 8, 9, 10, and 11. And after adding all that is there on the left hand column, which comes to 24,85,000, we have reduced what is there on the right hand side column, and then finally we found the net balance of 1,85,000 rupees. Now every T account like this shows only amounts and not the description of the transaction here. So in the account we are not writing description, we are just showing the amounts. So before making an account, it is necessary that we write down every transaction in some way, just as we have numbered the transaction here. Similarly, we can number the transactions and write the details of every transaction separately, and we can write date also for that transaction. So before we make an account, we somehow, along with the date, we write the details of a transaction. Now what we have done here is that we have put the increase of cash on the left hand side in the above account and decrease on the right hand side, and we have ascertained the closing balance by deducting the total of the payments from the total of the left hand side. Now this kind of treatment of receipts and payments is very convenient. Now here we have talked about only one account, which is called cash. We can make similar T accounts when asset or liabilities are affected by any particular transaction. Let us take, for example, that in one transaction an investment has been made by owners of 25 lakh cash. So when we say investment is made in the company, which means that capital has been invested. Now, when an investment is made by the owner, it's called introduction of capital into the business. Now, introduction of capital or introduction of cash will affect two accounts, as we have seen that every transaction affects two accounts. Now, when the cash is introduced by the owner, two accounts are affected. First is cash and other is the capital. The cash increases and the capital of the owner also increases, and the stockholders' equity paid up capital also increases. So as we can see here, cash has increased 25 lakh and capital has also increased by 25 lakhs. In another transaction, let us see. We are just seeing the transaction, how they are affecting the two accounts in double entry system. Now let's say that in the second transaction, an amount of 14 lakh is paid to the creditor. Now here what is happening is that this will affect the cash account and will also affect the creditor account. So the cash will decrease by 14 lakhs and the creditor will also decrease by 14 lakhs. So after taking all these examples, we can say that when we are writing an account, the more appropriate way to write an account is that we can include the date also, and we can include particulars of the transactions also, and some reference number and amount on the left hand side, and again on the right hand side the same four columns: date, particulars, reference, and the amount. On the right hand side we are writing all the increases, and the left hand side we are writing the decreases. So anybody can look at these columns and understand. Obviously here the reference column means that this reference is coming from the source of the information that is being included in the account. So reference column indicates the reference number of the source where the information about the entry is available and from where this entry is coming here, which is in fact the journal entry, from where this entry is coming into the account here. So now what we have seen is that in T accounts we write the increase and decrease entries on the left and right side of the accounts for assets respectively. We just saw here that when we are dealing with assets and there is an increase of the asset, we write it on the left hand side, and decrease of the asset entry is written on the right hand side. And for liabilities, whenever there is an increase in the liabilities, we do the vice versa of it. So as we have written in the case of assets, the increase entry we have written on the left hand side, but in the case of liability, the increase entry we make on the right hand side and decrease entry we make on the left hand side. So, but the accountants don't use this word decrease entries or increase entries. They formally use the terms debit to denote entry on the left side of the account, and credit word is used to denote an entry on the right side of the account. So when we say credit an account, it means that we are going to make an entry on the right side, and when we say debit an account, we say that what we mean is that we are making an entry on the left side of the account. Now we are aware of the accounting equation because that when we deduct the total of liabilities from the assets, what we get is the capital. So the accounting equation is called assets equal to liabilities plus capital, or assets minus liabilities is equal to capital. And to understand this equation better, you can also write it like this, that assets will be equal to liabilities plus the stockholders' equity, which is the capital, in case of the company. Or if you want to become more descriptive, we can say assets will be equal to liabilities, and stockholders' equity, instead of that, we can say the contributed capital plus the beginning retained earnings plus revenue minus expenses minus dividends. Because even the revenue will add to the capital, the expenditure will reduce from the capital, and dividends that we pay out to the stockholders will also reduce from the capital. So here, when we say contributed capital, it means that contributed capital is the owner's capital which he has contributed. When we say beginning retained earnings, what we are trying to say is that these are those earnings which have been made by the business and which have not been distributed to the shareholders. By revenue, what we mean that the revenue which is generated from the activities of the business, and expenses, by expenses we mean the cost which is incurred or expenditure which is incurred for company operations. And by dividends we mean the earnings of the company which are distributed to the shareholders as a reward for holding the shares of the company. So it is easy to understand that whenever there is a revenue, it will add to the capital. Whenever there is an expense, it will reduce from the capital, and wherever the dividend is distributed, that will also reduce from the capital. In essence, after distributing the capital, and we take the net of the profits and add them to the capital. Now, we have observed that whenever there is any change on one side of the equation, what we mean is that whenever there is a change in one side of this accounting equation, there will be a corresponding change on the other side also, so that the equation is always validated. So it can be illustrated like this, that let us say we take these 4 examples to understand how this equation is remaining balanced all the time. Let us say that to start the business, a cash of 10 lakh is introduced into the business. Now, when we say business is started with cash 10 lakh rupees, now the equation is total assets is equal to liabilities plus owner's capital. So when we introduce cash, total assets is cash, which is 10 lakh rupees. There is no liability at that time, and plus owner's capital is 10 lakh rupees. So 10 lakh is equal to 0 plus 10 lakh. Then supposing that person or the company borrows 5 lakh rupees from someone, and when 5 lakh rupees is borrowed, it increases the cash balance. So we get an addition of 5 lakh to the asset, and when we borrow, our liability is also increased by 5 lakh. Of course, there is no change to the owner's capital in this transaction. So once again, as we increase 5 lakhs to the left side of the equation, which is part of the total assets, we are increasing something, the same amount to the right side of the equation, that is 5 lakhs. So the equation remains balanced. Now then, let's say that the owner withdrew a cash from the business of 2 lakh rupees. When he withdraws cash from the business for personal use, let's say, the cash of the business gets reduced by 2 lakhs, and the owner's capital also gets reduced by 2 lakhs because he has taken it outside of the business. So again, we can see the equation is balanced. Now let's take one more example. Then let's say that a loan which was taken earlier is repaid to the extent of 1 lakh rupees. So when we repay the loan, our cash gets reduced by 1 lakh minus 1 lakh, and our liability also gets reduced by 1 lakh, so minus 1 lakh there also, and there is no change in the owner's capital there. So again the equation is balanced. So what we have noticed is that by every transaction this accounting equation is always balanced. But of course, what has been given above is suitable only if the number of transactions is small. If we have a lot of transactions, if number of transactions is more, we adopt a different procedure for putting increases and decreases in different columns, and that will be more useful and it will lead to more significant information. So which is that more significant method of putting that information? So we do it like this, that the same above transactions, we make accounts of assets and liabilities, and in that we put columns of increase and decrease, and we make similarly increase and decrease column for liabilities as well as for owner's capital. Here, instead of writing minus and plus, we have included separate columns for increase and decrease. Now, as we can see that all the assets now are, whenever there is a change in the asset, if it is increase, we are writing on the left hand side, or decrease, writing on the right hand side. In case of liabilities, where there is a decrease, we write it on the left hand side, and in case of increase, we write it on the right hand side. And in case of capital, again, if the capital increases, we write it on the right hand side, and the decrease we write on the left hand side. This makes it more simpler and easier to understand. So it has become a tradition. It is what has become a tradition, that whenever assets are increased, they are recorded on the left hand side. Whenever assets are increased, they are recorded on the left hand side, and whenever assets get decreased, they are recorded on the right hand side. And in case of liabilities and capital, the treatment is the very opposite. That means that when they are, or rather when liabilities and capital are increased, they are recorded on the right hand side, and when they decrease, they are recorded on the left hand side. So this has been a tradition. Now when we put together the two sides in T form, the left hand side we call the debit side, and the right hand side we call the credit side. So when in an account a record is made on the debit or the left hand side, we say that we have debited that account. And when we make a record on the right hand side of any T form or account, we say that we have made a credit to that account. So from this discussion now we can obtain certain rules. And the rules are like this, that whenever there is an increase in the amount of an asset, whenever there is an increase in the amount of any asset, its account is debited. Because when there is an increase in the amount of any asset, account is debited means entry is made on the left side of the account. And the account will be credited if there is a reduction in the amount of the asset concerned. Let us say, for example, that firm purchases furniture for 8 lakhs. So the furniture account will be debited because the furniture is increased by 8 lakh rupees, because the asset has increased by this amount. Supposing later on the firm sells the furniture to the extent of 3 lakh rupees, the reduction of the furniture value will be recorded by crediting the furniture account by 3 lakh rupees. So we are showing here a furniture account where when the furniture is purchased, the furniture account is debited because every increase in the asset is written on the left hand side and every decrease in the asset is written on the right hand side by tradition or by convention, whatever you may like to call it. Similarly, if the amount of liability increases, the increase will be entered on the right hand side or the credit side of the liability account. That is, the account will be credited. Similarly, a liability account will be debited if there is a reduction in the amount of the liability. Example is that firm borrows 5 lakh rupees from Mohan, and when a firm borrows 5 lakh rupees from Mohan, Mohan's account will be credited because that's a liability account. Since 5 lakh is now owing to him, so Mohan's account will be credited. We'll make a right hand side entry because that there is the balance in that account is increased. So the liability has increased. Later the loan is, supposing later on we repay the loan to Mohan, Mohan's account will be debited by the repayment, and if the entire loan is repaid, then nothing will remain in Mohan's account because it will be debited by the same amount as the credit. So Mohan's account will have no balance after the loan is repaid to him. Similarly, whenever there is an increase in owner's capital, we credit the capital account. In that sense, the capital account and the liability account are fashioned in a similar manner, and the asset accounts are fashioned in the opposite manner to capital and liability. Supposing the partner introduces some additional capital, or supposing the proprietor introduces some additional capital, what we do is that we credit the capital account, because in case of capital account, whenever there is an increase, we write it on the right hand side. If the owner withdraws some money, or rather we say that he makes a drawing for personal use, we debit the capital account in that case. Now, some more conclusions that we can draw here is that whenever there is a profit, the capital account is increased, and whenever there is a loss, the capital account is reduced. So as per rule 3 of the capital account here, whenever the profits are there, profits and incomes will be credited to the capital account, and all the losses and the expenses will be debited to the capital account. However, it is more useful if we record all the incomes, gains, expenses, and losses separately first, and thereafter we bring the net effect into the capital account. So by doing so, or rather by having the incomes, gains, expenses, and losses recorded separately, we will have very useful information regarding the factors that contributed to that year's profits or losses. So therefore, by keeping a separate record of incomes, gains, expenses, and losses, we'll have very useful information about the reasons for more profit or more losses of that year. Later on, from these separate accounts, we can get the net result and adjust it into the capital account. And the fifth rule that we can summarize from the above discussion is that all the expenses will be debited and all the incomes will be credited. All expenses will be written on the debit side and all incomes will be written on the right hand side or the credit side. because all the incomes and gains increase the capital, the rule is to credit all the gains and incomes in the accounts concerned. And because expenses and losses they go to decrease the capital, the rule is to debit all the expenses and losses. Of course, there is a reduction. If there is a reduction in income or gain, the account concerned will be debited. And if there is a reduction in the expense or loss, the concerned account will be credited. So very logically, proceeding from the initial tradition that is followed, where whenever we write assets or in such a manner that we write whenever there is an increase of the asset, we write it on the left hand side. We were writing on the left hand side. Whenever there was a decrease of any asset, we were writing that on the right hand side. And we were doing the opposite in case of liabilities and the capital. And whatever we were doing in case of the capital, the same thing we were doing for incomes and losses. By doing all that, by just making a logical conclusion, we can summarize all the rules and jot them down here. So what are finally the rules for debit and credit? These rules are that whenever assets are increased, the asset account is debited, and whenever assets are decreased, the asset accounts are credited. Number one. The second rule is whenever liabilities are increased, the liability account is credited, and whenever liabilities are decreased, the liability accounts are debited. Third rule is that whenever there is an increase in the owner's capital, the capital account is credited, and whenever there is a decrease in the owner's capital, the capital account is debited in case of decrease. And fourth rule is that whenever expenses are increased, the expense account is debited, and whenever expenses are decreased, the expense account is credited. On the other hand, whenever revenues are increased, the revenue account or the income account is increased, are credited, and whenever revenue or incomes are decreased, the revenue or the income account is debited. So these are the 5 golden rules of debit and credit. So the terms debit and credit should not be directly be understood to mean either favorable or unfavorable things like we use in literature, but debit just means the left hand side and credit just means the right side. That's all. We should not make implications of profit or loss from debit or credit, or favorable or unfavorable from these words. Now let us take an illustration. We have some transactions before us, and we'll like to put them in the respective accounts after applying these 5 rules, and we'll see how we can put the transactions in the correct account. The first transaction is that R starts his business with rupees 5,000. Now, when we say that R starts his business with 5,000 rupees, it means that he is increasing his capital. So, from this transaction, 2 accounts will be affected under the double entry system. One is the bank account, and other is the R's capital account. Let's say he has made a check payment to the company. So in the company's bank account, 5,000 increase there, and at the same time in R's capital account, 5,000 increase would be there. Now these 2 accounts here, as far as these 2 accounts are concerned, the bank account is an asset account and capital account is a capital account. So here what is happening is that asset account is increased and the capital account is also increased by, both are increased by a similar amount, that is 5,000 rupees. So we are trying to understand in which accounts the entry would be made of that particular transaction. Once we understand in which account entry has to be made and whether it has to be debited or credited, then we can easily write the journal entry. So here in the first example, what we are doing is that we are debiting cash, or we are debiting bank rather, it is an asset account, and we are crediting capital by using the above rules. Let's take the second example where furniture purchase is made for 1200 rupees. Here the two accounts that are going to be affected are the furniture account and the bank account. Furniture is an asset account and bank is also an asset account. As the furniture is increased and bank balance is decreased, so we debit the furniture account and we credit the bank account. And as we can see here, both are the assets accounts. So there is an increase in one of the asset accounts and there is a decrease in the other asset account, and therefore the accounting equation remains balanced. Now, third example is that an amount of 1,500 is paid as salary to an employee. Now here, two accounts are affected. One is the salary account, another is the bank account. The salary account is an expense account and bank account is an asset account. Expenditure account is increased because 1,01,000 is paid as an expenditure of the company, and asset is decreased because the bank balance is reduced, and bank being the asset account here. So two accounts which are being affected. One is the expense account, which increases, and the asset account, which decreases. Now let us take the other example. Rent of 1,500 is 1,100 is paid. Here, by paying the rent, two accounts are affected. One is the rent account, and another is the bank account. With every transaction, as you can see, two accounts will be affected, and they'll be affected in such a way that the accounting equation is always satisfied. As we have seen earlier, the accounting equation is always satisfied. So here, when we pay 1,150 as a rent is an expense account, so that is expenditure is increased, so we say it is debited, and the bank account is credited. Fifth example is interest of 2,000 rupees is received, so this will affect two accounts, interest and cash. Cash will be an asset account which will be increased, so it will be debited by 2,000, and interest income account, interest account is increased because interest is received, so that is a credit entry. So in this manner, by applying those 5 rules and the earlier discussion, we are able to understand which account is to be debited by how much amount and which account is to be credited by how much amount with every transaction.
Sir, I have got two questions to ask.
Yeah.
Sir, in second column, as you can see, there is purchase furniture for rupees 1,200. So over here cash is not mentioned, so we are supposed to take it as the amount of 1,200 was paid by check.
Well, when they are writing purchase furniture for 1,200 rupees, it is always possible that furniture could be purchased by cash also. So because in the third column here they are writing that they are writing bank, so which therefore implies that check was paid to purchase the furniture. Of course, when they are writing purchase furniture for 1,200, and when a question is asked, then you cannot make any assumption that it has to be done with bank or cash. And if you make any assumption, if nothing is given, then if you make any assumption, then that assumption has to be written down in your answer if it is not a multiple choice question. But of course, if it is a multiple choice question, in that case, the person who prepares the question, he should not create a confusion by giving choices in form of cash as well as the bank account. So therefore, when we say that we have to make an assumption, that that assumption part relates to an essay type question, where if it is not specified whether the payment is made from bank or cash, then you can assume it. But of course, the multiple choice question, you don't have any choice to make any assumption there. And it would be more appropriate if the question is framed properly. Because there is no such assumption available in accounting that if nothing is mentioned, then you should assume that it is bank. There is no such rule in accounting that such assumption should be made.
So then we can take either of the assumptions, like we can take cash or we can take bank.
If it is an essay type question, you can take either of the assumption. Yes, definitely. Because there only you can make an assumption. If you make an assumption, that's fine. A payment can always be made from bank. Payment can always be made from cash, unless there is a payment which is prohibited, where you can't make any assumption. So all these small payments can easily be made by cash as well as by bank, anything. So any assumption would be fine in this case. So what is the second question?
Similarly, sir, in column number 5, it is written that received interest rupees 2000, and in accounts involved it is cash and interest. So it is not a banking interest, right?
Same thing is here again, cash. The interest is received in cash, and they are assuming that the interest is received in cash. So here you see this illustration. In this illustration or in this example, those who are in this, those who are writing the illustration here, they are not writing this illustration to make you assume anything at all here. Here, what they are trying to make you understand is that whenever there is any transaction, it will affect two accounts, and the two accounts will be affected in such a manner that the accounting equation will be balanced. And therefore, whenever there is a transaction, we have to try and understand which are the two accounts which will be affected by it. And the intention of the person who's writing the illustration is not to make you assume anything, because in the third column itself he's writing that cash. When he writes cash, that means that what he means is that interest was received in form of cash. And of course, there is one more element to it, that sometimes in the cash account there is a bank column. So yes, at times there is a bank column and a cash column in the cash account itself. Sometimes you write it as a bank account whenever there are no two columns and there is only one column. Then you write it as a cash account. And whenever there are more than one column, like one bank column and one cash column, then you just name it as a cash account. And of course, they are writing a bank account also here sometimes. So not to be confused by that, because in case there is any essay type question, you can always make an assumption, and you are free to make an assumption if it is not mentioned that whether the payment was in cash or bank, and both the answers will be correct from that point of view. Okay, is that right?
Yes, sir.
Okay, so I think we can bring this session to an end with that, and we can continue the session. You can read through the document yourself also. We'll start with transactions in our session tomorrow morning, at 8 o'clock. So we have begun with journal entries and we are proceeding systematically. I would like to request you all to pay one very careful attention to how it all started off. That earlier in the past tradition or convention was that whenever any asset was increased, it was written on left hand side, and whenever any liability was increased, it was written on the right hand side. And whenever any capital was increased, it was written on the right hand side. And similarly for income and expenses. So whenever any income was increased, it was written on the right hand side. Whenever any expenses were increased, it was written on the left hand side. So similarly, based on that tradition, all these rules have emerged for finding out whether which account has to be debited and which account has to be credited. Keeping in mind that with every transaction, two accounts will be affected at least. Not at least, rather exactly two accounts will be affected. One of the and both accounts will be affected in such a manner that the accounting equation will be satisfied all the time. So from that angle, please try to read this, and so that because this is the very basis of debit and credit entry in the transaction in the books of accounts. This is the very basis. So if you understand the very basis correctly, then only when you go forward there will be no confusion. Otherwise, a lot of confusion can emerge. So I'll request you to go through it very carefully. This is the journal entry chapter or unit, the most important unit of bookkeeping and accountancy. If you get it right, then you get the entire bookkeeping and accountancy right very easily. If you get it until you get this thing right, you won't be able to do the remaining part of it. The rest will become even more tougher. And if you get this particular unit right, the rest will be all very easy to understand. So please pay particular attention to this particular chapter on journal entry. And with that, we come to the end of today's session. And please join us at 8 a.m. tomorrow morning, or rather 7:45 a.m. tomorrow morning, for a continuation of this session. Thank you so much for having joined us. Wishing you the very best and a good night.